This is Matthew Cratter from Trader University, and today I want to answer the question, are low-price stocks actually cheaper than higher-price stocks? If you're interested in learning how to make money in both bull and bear markets, or you just want to see what I'm trading or investing in, be sure to hit that subscribe button. So in the wake of this video that I did on why penny stocks are dangerous, I got a very interesting question about Ford Motor Company from one of my listeners. And this was the question: why does Ford Motor Company, ticker F, stay below $10 per share? The company has been around forever and sells products all over the world. Compared to GM, Tesla, etc., why is Ford so cheap? This is a really good question. It's something that often confuses beginners when they're first learning about the stock market. I'm going to begin with the analogy of a pie. You have a pie and you can cut it into as many slices as you want. This pie could be cut into 4 slices or 100 slices or 10 slices, and it would still be the same sized pie and contain the same number of calories, etc. Now, market capitalization is just like this pie. The market cap of a company, which you probably heard the term, just refers to the total number of shares outstanding. So a share of stock is just a little slice of the pie. It's a little slice of the whole company that's been divided into a number of shares. So if you take the number of shares outstanding, the number of shares that are out there, times the stock price, you'll get the total equity value of the company, which is called the market cap, or the market capitalization. This is the value of the entire company, of the equity or the ownership piece. Doesn't take into account debt or cash on the balance sheet, which I'll probably say for a different video, which you have to use something called enterprise value. But when you're asking about shares of Ford stock and why they're so cheap, it's fairly arbitrary. One could do a reverse split on Ford. Right now it's trading at about $8.92 a share. It'd be very easy to cut in half the number of slices of the Ford Motor Company pie, and all of a sudden you could double the stock price. And so there'd be half as many shares outstanding. The stock price would be twice as much. So it would be about approximately $18 per share. But the real way we compare company size, and you'll hear about these mega market cap companies like Amazon, Apple, Facebook, Google. When we say a company is really big, we may be referring to its revenues, but most often we're referring to its market cap, the biggest companies in the world. So Ford Motor Company has a market cap of 35.6 billion. Now, the way you get to this number again is if we click right here where it says, statistics, it'll take us to the next page here, and we can scroll down and see the number of shares outstanding right here, 3.91 billion shares outstanding. You just take that number and multiply it by 8.92, 8.93. That gets you the market cap. And as we can see here, the market cap of Ford is currently at about 34 billion. Now let's compare that to GM and Tesla, as the person who asked this question was referring to. So if Ford has a market cap of 34 billion, GM has a market cap currently of 59 billion. Tesla's the largest market cap company in the world now, I believe, and it has a market cap of 387 billion. Again, that's just all the number of shares times the current stock price. Now, in this case, it looks like as the stock price goes up, so Ford has the lowest price per share, then GM, and then Tesla. In this case, the market cap goes up as the share price goes up. But I can give you an example of a company that has a lower stock price. In other words, a lower price per slice of pie than Tesla, and that would be Apple. So Apple, you can buy one share for $118.47. That will get you one slice of the pie, but it has many more shares. And so the market cap of Apple, as we can see right here, is approximately $2 trillion. Again, the share price is 118 compared to a Tesla share price of 455. Tesla has the higher share price, but the lower market cap. There are fewer slices of pie. And so a lot of people get confused. They think that if they buy low-priced stocks, that somehow these will become higher-priced stocks. But the real thing to look at is the market cap of the company. And what Tesla is pricing here, Tesla doesn't have that many earnings now, but what it's pricing in is a massive growth of future revenues, future profits, future free cash flow, future market share. And so growth stocks like this get priced a little bit differently. So let's now that we've talked about market cap and sort of the relative sizes of companies, let's take a look at the quality of a business. So if we go to Ford and we go click here on statistics, it'll take us to this page and we can take a look at some of the common metrics you look at when you're evaluating a business. We can look at profit margin, operating margin. Profit margin is just how much earnings do you have for $1 of revenue. What is your net profit made on $1 of revenue or sales? Now Ford has a negative number for this simply because it's been losing the last couple of years. It's actually been losing money on every dollar of sales. It also has a negative return on assets, a negative return on equity. So these are all very, very poor numbers. If we go and take a look at the financial statements, we can click right here on financials. We'll see what's happening here. If we look at the income statement, the last 12 months, Ford has had revenues of approximately 131 billion. This is, all numbers are listed in thousands here, so you have to add 3 zeros to read this properly. Revenues call it 131 billion, and somehow they managed to lose $163 million on that 131 billion in revenue. Now, nothing against Ford. I do like their trucks, but as a business, you would never want a business like this. It looks like it's in decline. Just a couple years ago, it was making 7.6 billion in net income or earnings, dropped to 3.6 billion, dropped to 47 million, and now it went negative. Now we know that car sales are fairly cyclical. These car sales will probably come back at some point, unless all the people who currently own Fords decide to buy Teslas. This is obviously a very slow generational process that doesn't happen overnight. So if you're going to have a view on Ford, you have to have a view on whether they can regain market share and also what sort of profit margins they can attach to that. Because you can see they sell a lot of trucks, as the person who asked the question pointed out. They have gigantic revenues. They just have very high cost of revenues, very high expenses, high operating expenses, etc. And so they also have a lot of debt. They have to pay interest on the debt as well. And all of this subtracts from revenues and leads to a negative net income number. Now let's compare that to General Motors, which has a slightly higher market cap. Let's take a look at its profit margins and return on assets, return on equity. We can see that it's got a low single-digit profit margins, net profit margin of about 3%, and it's just eking by return on assets 1%, return on equity 6 or 7%. Let's compare those numbers to Tesla. If we scroll down for Tesla, Tesla also has very razor-thin profit margins right now. Slightly better return on assets, return on equity. Return on assets is just net income divided by the total assets that you have. Return on equity is just net income divided by the book value of the company. So these are still mediocre, but what the market is looking at here for Tesla is they're looking at huge revenue growth, and they're relying on Musk to turn this revenue growth also into profit growth. We can see that just a few years ago, Tesla had only about 7 billion in sales or revenue, and that number has just been growing exponentially every year. And they were finally profitable from a net income perspective over the last 12 months. So they went from having a $2 billion loss in 2017 to having a half a billion dollar gain in the last 12 months. But let me show you what a healthy, mature company looks like, especially a company in the tech industry that doesn't have to deal with, that does more software and more subscription based. Obviously, Apple makes hardware as well, but they've really been transitioning let's take a look at what their profit margins look like. So they have a net profit margin of 21%, operating margin 24%, and then really good return on assets, really good return on equity. So this is the sign of a really good business. It's got double-digit profit margins, double-digit return on assets, and return on equity. So these are the sort of things you want to analyze when you're analyzing a company. It's the same way that if you owned a fast food store or something like that, would you want to make 20 cents on every dollar of burgers that you sold, or would you want to make 2 or 3 cents on every dollar of burgers that you sold? So profit margins are very important to the health of a business. They give you cushion to reinvest. You can use, if you have very high profit margins, you can use that excess money to buy other companies, to invest in R&D, and to also grow your company in other ways. Now, traditionally, when we're talking about whether stock is cheap or expensive, if you're in the investment industry, you're normally not referring to the stock price. The stock price could be anywhere. In the world we live in right now, the higher quality companies tend to have higher quality stocks, and that are higher price stocks. The higher quality companies tend to have higher price stocks. That was one reason in this video I was saying, in addition to avoiding penny stocks, if you're just starting out, you should also avoid any stock that trades below 20, because these tend to be, not always, but they tend to be lower quality companies. But when you're talking about whether a stock is cheap or expensive, and you're in investment management, what you're normally referring to is something called valuation, which is a measurement of the price of the stock compared to the earnings. So you can calculate PE. You've probably heard of price to earnings. You can either take the price of a single share of stock divided by earnings per share, or you can take the market cap of the company divided by total net income. That gets you the same number. In one case, you're just looking at the income for the entire pumpkin pie. In the other case, you're looking at the income per slice of pie, but it gets you the same number. And there are these various valuation metrics that you can use: the PE of a stock, the price to sales ratio, the price to book. Now, a lot of people don't realize, but the earnings yield of a stock is just the inverse of the PE. So if a stock has a PE of 20, the earnings yield is just the earnings per share divided by the price per share of stock. And so if you just invert this, 1 over 20 is 5%. So one way of thinking of a stock that has a PE of 20, it's a little bit like a bond that has a yield of 5%. Now, these earnings will not all be paid out as a dividend, as a check that's sent to a shareholder, in the same way that a bond coupon will be paid out. But it's a way of thinking, comparing a bond to a stock. Now, stocks' earnings obviously aren't fixed like bond payments. Bonds have credit risk, but stocks can also grow their earnings. They can shrink their earnings. And so what high PE stocks are basically telling you is that the market expects the company to grow its earnings a lot in the future. A high PE stock has a good long runway ahead of it. If we look at the PE of Ford, for example, it doesn't even have a PE, simply because you can't calculate a PE when a company has lost money, when it would have a negative PE. You can look at the forward PE, which is what the market is expecting future earnings over the next 12 months to be divided into the price. So we can see that Ford trades at a very low PE because the market is not expecting much growth. They're not expecting the company to really increase its earnings over the coming years. If we look at General Motors, it has a trailing PE. Its earnings were very small, so it has a very high trailing PE. This is what you'll often see in cyclical companies, where the PE really bounces around a lot, and the earnings are fairly volatile. Now, if we look at Tesla, finally, we'll see that Tesla trades at a very high PE, a trailing PE of 776, forward PE of 106. Now, this often scares off value investors, but what we found over many years, over the last 20 years really, especially with these high-tech businesses, for example, Facebook, Netflix, both traded at very high PEs, and then they grew into their valuations. They grew earnings a lot, such that their PEs came down. If we take a look at Facebook, let's see, we'll go to statistics here. We can see how the PEs have moved over the years. Well, this doesn't totally go back far enough. Basically, the trailing PE for Facebook has been fairly steady in the high 20s or low 30s. But if we could go back further, we would see that when it first came public, it was trading at a PE of something like 100 or 150. If we have a stock like Apple, Apple has managed to increase its PE as it's increased its earnings over the past few years. And that's one reason that it's grown. The stock has appreciated so much because not only have earnings grown, but the multiple, the PE multiple attached to that has grown as well. So if we look at, well, this looks like these were quarterly numbers we were looking at, but even in going back to the third quarter of 2019, Apple traded at a PE of 19, currently trading at a PE of 36. And part of this is that transition to higher margin products, subscription revenue, and this sort of thing. So as I said, PEs will often take into account the future growth of the company. You'll pay a higher PE for a stock if market participants believe that it has a lot of growth ahead of it, which would mean potential for the company to grow its market share, its revenues, its sales, its earnings, etc. Now, if you're a trader, if you're focusing on very short time horizons, you don't have to worry about a PE. For day trading or swing trading, PEs are really irrelevant. But what I have found is that the best momentum stocks and also the best growth stocks for investing these days have high PEs. And a lot of investors have really missed out on amazing opportunities like Apple and Amazon, Facebook, Google over the last 10 or 15 years because they were so fixated on the high PEs. The inverse of this, though, is that if you're looking for low PEs, if you're fishing in this pool of stocks that have PEs of 15 or below, these are companies that are normally in declining businesses. Maybe they make typewriters or buggy whips or fax machines, this sort of thing. Or they're fraudulent companies, or they're highly cyclical, which means they can go up. Their business can rise or fall a lot with the economy. It also, a low PE stock can simply mean that the company has a huge amount of debt. And so that if anything goes wrong on the debt side of things, the whole thing can blow up. And so commodity stocks, cyclical stocks, like home builders, for example, tend to trade at much lower PEs. And their PEs are also very volatile. They move around a lot. If you found this video helpful and you really want to learn how to dig into financial statements, I would recommend my course, Financial Statement Analysis Made Easy, where you learn what Warren Buffett calls the language of business, which is accounting, how to read financial statements, so how to read an income statement, a balance sheet, a cash flow statement. These are very useful for long-term investing. Now, as I said, value investing doesn't work as well anymore, but it's still very important to be able to look at a company's financials and analyze it. If you want a strategy that does work really, really well in this environment, I'd suggest you check out my Momentum Stock Secrets course that goes into everything you need to know to trade momentum stocks, including where to enter, where to exit, how to size your position, risk management, the best place to find momentum stocks, etc., as well as a bunch of secret indicators that I've developed. Now, the good news is you don't have to choose between any of these courses. If you join Trader University Premium, you get access to all 15 courses that I have on the website, including my flagship course that will really get you started if you don't know anything about trading or investing. Learn to trade stocks like a pro. I also have a course on day trading, course on how to make money with IPOs. I have a list of my favorite momentum stocks that I share every week, as well as a couple courses on how to trade options and futures, as well as you can follow along with my Bitcoin and crypto investments. If this is something that interests you, you can just click on the description, on the link in the description notes below this video. It'll take you to this page, and then you can click on any of these boxes if you're interested, and it will give you the list of lectures, and so you can see what's covered in each course. If you'd like to try it out, you scroll all the way to the bottom here, click Get It Now, and that'll take you to this checkout page. I have a special coupon for you Normally, access to all 15 courses is just $125 for 30 days. But I want to give you a coupon because you've watched this far. If we click right here where it says have a coupon code and you type in YT, capital YT as in YouTube, 99, click update, and that'll take $26 off the price. So you'll get access to everything, every single course for just $99 for 30 days. You can watch all the courses, cancel before your subscription is up, and you won't be charged again. There are no long-term contracts or anything like that. Or you can stick around and watch as I add new courses to Trader University every month. If there's a course you're missing that you'd like to see added, you can just let me know. I'll record the course and add it to the curriculum and give everyone access to it. And this way, I hope to make Trader University one of the best resources for both trading and investing on the internet. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.